I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we are talking about PMI. What is this mortgage insurance? How do we calculate it? I mean, this is all about like these numbers. How do you just figure it out?
Yeah, that's right. PMI. First off, do people know what PMI stands for?
You know,
probably,
a lot of people
probably
don't.
not, right? Yeah. So private mortgage insurance.
Mm-hmm.
You know, and those that really are kind of geeky about mortgages, they just love talking about, DTI, PMI, all these different LTV. But so you'll hear these acronyms, but that's what PMI is, private mortgage insurance. And this is for Fannie and Freddie. Okay. So this is for conventional loans. This is not FHA.
Yeah. And a lot of times people don't even know who Fannie and Freddie are. They're like these brother and sisters, right? They're these agencies that buy conventional loans.
Right.
So most of you have a conventional loan. And if you have a conventional loan, again, that's private. It's non-governmental. So if we're talking about an FHA loan, that's government mortgage insurance, right? And so that's why that PMI is specifically regarding conventional loans.
Private mortgage insurance.
Or really any time it's a privately insured.
Yep.
It's not government insured. Okay.
And then for people that are watching this on a Friday night, just because they're so excited about mortgages, PMI is for any loan that has less than 20% down. So if you have more than 20% down, you won't be listening to this. But if you have less, you will have PMI. Okay, so how is it calculated?
So there's, I was trying to count here. There's 6 factors. There's 6 things that the lender needs to know in order to calculate it. So so if you have less than 20% down, right? The question is how much are we going to put down?
Mm-hmm.
Like 5% down, 10% down, 15%. Okay.
Right. And it doesn't matter. It doesn't matter in any increment other than in a 5% increment. Okay.
Yeah.
So there's 5% buckets. Okay. What's next?
Okay. The loan amount size is another factor. How many borrowers are on the loan? You get a little bit better mortgage insurance rate if you have 2 borrowers.
Good call. So having 2 people on the loan, with that means maybe a little less risk. Little less risk. You got 2 people. Okay, good.
Right. The credit score, of course, higher the credit. Anything above 760, you're just in the top tier. But everything below 760 is every 20 points. And there's different scoring.
Okay.
Whether the property type. Okay, so if you're buying a single family residence, you're going to get a little bit better mortgage insurance factor than a higher risk product like a townhouse or condo.
Good point. Good point. All right, so 6 different factors.
And then one more is the whether it's your primary residence, your second home. Okay, now and I'm going to say investment property. There is mortgage insurance available on primary investment properties, but it's you can put 15% down. It's one of those little numbers. But anyway,
we don't get a lot of PMI folks on investment properties because the minimum down is 15. So by the time you get to 15, that PMI factor is pretty low, and a lot of our investors are actually wanting to avoid PMI. Yeah. So when we talk about PMI, it's typically primary occupancy.
Yeah. So, all right. So what we're going to do is we're just going to show you an example of what a quote looks like. We're going to put it up on the screen. This is from the private mortgage insurance company Radian. They're one of the big. They're a public company that's traded in Radian here. So what I put in these factors, I put in a 5% down product, a 5% down loan, a $200,000 loan amount, 1 borrower, a 760 credit score, single family residence, and a primary. So you're living in the home. And what you'll see is that the mortgage insurance factor is 0.36. Okay, so in the background, as a customer, you're getting a loan, but what's happening when you look at that mortgage insurance and you look at the dollar amount, you're like, I wonder why. You'll look at these like a quote, and it'll say $60 a month for mortgage insurance. Okay, so if you were looking at our sheet, you would see $60 a month for that scenario, and that's because the mortgage insurance factor is 0.36,
and there's 0.36%.
0.36%. That's multiplied by the loan amount. And then divided by 12, okay?
Right.
Because that's the annual rate. So you divide that by 12, and it comes up with the $60. All right, so that's how much it costs per month.
Per month when you start. Now, how about you're in the loan? Does it move? Does it go down? Does it go up? What happens to it?
So we're gonna talk about the type of mortgage insurance that about 98% of people get, and that is what we call it borrower paid. The borrower, you are paying the mortgage insurance monthly, and there is an adjustment period after the 10th year.
Holy buckets, 10 years.
So is it fair to say that it goes down? I mean, it is fair because it's accurate to say that your mortgage insurance factor is going to stay 0.36, for example, on this quote, all the way through year 10. And on the 11th year, it will drop. And in this case, it'll go down to 0.2. Okay.
I wonder how many people actually stay in their loans long enough to have it reduce like that, because most people are refinancing before the 10th year. So that really doesn't come into play, but that's important to know that it really is static for 10 years.
Yes.
10 years in terms of the rate. The monthly amount will go down as the loan amount goes down.
Yeah.
But the actual factor itself stays consistent.
Yeah, and in mortgage insurance, there is a law that says mortgage insurance has to be removed when the loan amount reaches 78% of the original value. Now, that usually occurs around year 12 anyway. So, well, a lot of times, like you have to look at your numbers, but yeah, I mean, it's something. It won't be on there forever, but technically, it is. It's not assuming. It's assuming it's giving you the schedule breakdown anyway. That's how it looks. I forgot, man. There is one more. There is not 6 factors. There's 3. There's 3 factors. We forgot about the debt to income ratio. Okay,
the debt to income. Oh, right.
Yeah.
Good.
When the debt to income ratio is above 45%, there is usually an extra add-on fee. So that's just what we be careful of. So, it's the down payment, loan amount size, how many borrowers, your credit score, the type of property, and whether you're going to be living in it or second home, and your debt ratio.
Right. For those that have a high debt ratio, again, the lenders are looking at that, saying there's a little higher risk in that loan. If you're maxing out everything, that's different than someone who's got a super low debt to income ratio, no worries, not a lot of payments. So, all right, well, good. Anything else that we left out?
No, I think that covers it.
Okay.
There's a lot of things that govern mortgage insurance. We can always cover more, do more podcasts on. But again, this is the bolts and nuts.
Yeah, I like it. The bolt nuts of PMI.
That's right. Okay, everyone, you have a good day. Take care.
All right, folks. Thanks.
Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.